Hello, I'm Pat Zumbush, your YouTube CFP professional, back with you with another episode of 3 Minute Money. If you've never invested before, or perhaps need a refresher and would love to know what a stock is, this video is for you. I could probably spend 3 to 4 days talking about stocks and how they work, but let's start that 3-minute money timer and see if I can give you an extremely high-level overview of stocks in 3 minutes or less, hopefully. A stock is a type of investment that represents an ownership share in a company. When you purchase a company's stock, you're buying a portion of that company, called a share. As the stock owner, you are called a shareholder because you share in the company's profits and losses. Investing in stocks can grow your money and outpace inflation over time. Shareholders make money when stock prices go up, but they can also receive dividends and in some cases vote during shareholder meetings. You might be wondering why companies issue stock in the first place. When companies start up, they merely have an idea but no money to finance the new venture. The company will then issue stock to raise funds for the development and growth of its business. If an investor buys 100 shares out of the total of 10,000 shares of the stock that a company issued, those 100 shares represent 1% of the company's total capital stock. If the investor paid $50 per share, it would cost them $5,000 to buy those 100 shares. Investing in a company's stock is just the beginning of the process. Ultimately, an investor hopes the company does well and makes money. Why? Because the stock that the investor owns represents not only a partial ownership in the company's copier machine or building, but also a share in the profits of that company for the future. Imagine a hypothetical investor investing in a company that will stay in business for only 1 year. And at the end of that year, say, the company makes profits of $1 million. An investor's 1% share of these profits would be worth $10,000, 1% of 1 million. If the investor had initially bought the shares for $5,000, they would have tripled their money, the $5,000 plus the $10,000. Companies strive to stay in business for more than 1 year, obviously, so the company is valued at more than 1 year of earnings. Commonly, they're valued at 15 to 20 times their earnings. That is called the price to earnings ratio, or PE ratio for short. In reality, most investors don't buy shares of new companies, which is called an initial public offering, or IPO for short. Instead, they invest in the company through a stock exchange. Stock exchanges are nothing more than organized department stores where people buy shares of companies that they like or sell shares of companies that they don't like. Thanks for hanging out with me today. I hope you found it helpful. Be sure to give this video a thumbs up if you found it useful, and subscribe to my YouTube channel to stay up to date on all the videos. As always, thank you for letting me help you do wise things with your money.